Welcome to this week's version of Nickels and Dimes, our weekly video series. Today, I want to talk a little bit about where the stock market is relative to some other notable market tops. And I'm bringing this up today because there is, at least in our opinion, some very, very cautionary sign for the equity markets. And one of them is margin debt. And you may not know, but margin debt is basically borrowing against your portfolio to buy additional shares. So margin debt is some of the highest it has ever been. So in the history of margin debt, we are at all-time highs. And typically, when you see margin debt at all-time highs, the market, or at least an asset class, is near the top. So very concerning. So this is again a historical perspective. So I just wanted to share it with you. And one of the things that we want to look at is the S&P 500 and where we are in the market cycle. And this is the market over the last 25 years. Again, here's the price, and you can see dot-com bust on the far left, and then we had the financial crisis. You may recall in this time frame, this was what was known as the lost decade. And then the market bottomed out around March of 2009, and then we had a big run up. Of course, on the far right here, we had the coronavirus dump and obviously the recovery. So I'm bringing this up today because any asset class or indices has, of course, a price. And then it has also that moving average, which is basically the closing price over whatever period of time. And then effectively, there's a smooth out line. That's that white line here. Now, what's notable is on the far right here, this is where we are today. The price of the S&P 500 as of January 1st, 2022 was around 50% above that moving average. Why, again, is important? From a historical perspective, for example, when the financial market peaked in mid 2007, the markets were around 30% above this moving average, which in this case, again, is a 60-month moving average. Let's look at the dot-com bust. Back in August of 1999, right before the market collapsed over the subsequent 2 to 3 years, the S&P was around 64% above this moving average. This is important to look at historical norms. Now, traditionally, when price, whether it's a price of an indices or price of an asset or asset class, is well beyond or well extended beyond the norm, let's call the norm the moving average, you tend to get a very large correction or potentially even a bear market. Again, if you looked at 99 and 2007, those large extensions, 64% and 30%, ultimately led to very large bear markets over some years. And obviously, we've seen here around a 50% extension, if you will, beyond a moving average. So I'm bringing this up today because I want to. I'm not doing this to stress you out or to create fear. I'm doing this simply to have you become aware. Why? Because ultimately, one of the goals, or really the main goal when you're investing and managing money, is risk management. Protecting your capital in an ideal situation is your number one goal. But it also presupposes that you have a strategy to do that. Again, if the market ends up correcting, or if we enter in a bear market, again, because we're way extended above moving averages, you need to have a sell discipline and investment strategy. Now, it could be traditional asset allocation. It could be proactive raising cash, i.e. selling stocks. We talk about these things. Maybe it's buying options to hedge. So whatever your flavor, just make sure you have a protection mechanism in place so that you don't give back your profits, and of course, then you're also protecting your principal. To that end, if you would like a second opinion on your portfolio, again, to make sure you're properly hedged, if we do see another bear market rearing its ugly head, you can simply send me an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com to learn more about what we do. Again, risk management ideally is your number one goal when you're protecting, when you're investing and protecting capital. So please make note of that. Thank you again for watching. Bye-bye.